Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning on the program with us today is Frank Holmes. He's the CEO and Chief Investment Officer of U.S. Global Funds, which can be found at usfunds.com. He also runs Frank Talk, which has 40,000 readers in over 180 countries. Frank, welcome back to the program.
It's great to be with y'all.
You recently returned from the Cambridge show in Vancouver, which Palisade was at, and you gave a speech called What is Driving Gold? I think that's a good starting point today, Frank. It's 2017 now. What are the main drivers you see for the next 12 to 24 months for the gold market?
Well, I think it was interesting to see 2,500 people turn out Sunday morning in Vancouver for an investment conference, which was a major home run. And what I shared with the listeners there was that it's important to look at the macro and then what's driving the stocks is the other part of the thesis. But from a macro point of view, it's predominantly the fear trade, and that's negative interest rates. And so what are negative interest rates? What will the government pay you to buy their bonds, deduct the CPI, the Consumer Price Index, and therefore you get either a positive real rate of return or a negative. So a year ago, you had actually positive real interest rates. You were earning a higher yield than what inflation was running at. And then recently, it went negative. And that's when gold propelled up until after Brexit. And then rates started to go positive again, gold corrected, and now rates are going negative again, and gold has had great action.
Well, that's very true. And Frank, unlike many of the other participants we have on the show, you also track very closely the general markets, the U.S. equities. U.S. equities just flew through 20,000 on the Dow. And the concern, I think, of a lot of gold investors is now that gold stocks have started to go up for the past year, what happens if we get a pullback in the overall market? Is that something that's concerning you and your analysts over at U.S. Global Funds?
Well, let's talk very short term. We're going to Chinese New Year starts tomorrow and next week. And historically, whenever we have a holiday in China, like the first week of October or Chinese New Year, gold gets smacked down by whoever it is. I don't know, but they use the futures market where they only put up a few $1,000s to be able to leverage $125,000, $130,000. So I think we were at a stage like a year ago, an opportunity to buy in very short term. I think what's really important for the listeners to look at, why did gold stocks do so well last year? Well, is not only did gold rise, but they had got control, the gold mining stocks had got control of their cost structure. And what they went from basically making $50 an ounce of gold production, they were then making $350. So what we saw last year was that gold mining stocks, if you looked at the GDXJ and you looked at the 91%, that is about 34 companies, they saw over a double in their earnings, whereas the S&P was flat or down. So that the gold sector had the best attractive of looking at earnings momentum, and the quant funds went in and they drove those stocks up. I think that the gold mining companies all in have the great capacity to have another wonderful year.
Now, Frank, that's very interesting. Essentially, your thesis is that because of the bad times in the bear market for gold, companies finally got a hold of operating costs and optimized production. That mixed with a slight tick up in the gold price resulted in a great year last year. You see that over the next year, we could have this positive divergence continue, whereby the gold stocks continue to outperform gold itself?
Yes, I do. And I think any rally of gold between now and the summer of another $100, you can see these stocks tack on a 30-40% move. It's really, they're very lean. All-in costs were running at $1,700 when gold hit $1,900. So when gold fell down to $1,050, they were losing money. They've got those costs down all into $950 now. So anything above $950 is very profitable for the majority of gold producers.
Frank, an article floating around the internet you just put out, which is very popular, called "It Might Be Time to Grab the Commodities Bull by the Horns." This doesn't just talk about gold, but it talks about the surprise performance in 2016 of commodities broadly. Can you talk about why you think that commodities and not just the precious metal sector started to tick up now?
Well, one of the most important indicators I've written about extensively, and I update when the data comes out, is the PMI. That is the Purchasing Manufacturers Index. And it's forward-looking. Most economists look at GDP, which is like staring out their rearview mirror. And if you're going to be driving your car and you're going 60 miles an hour, you can't be staring out the rearview mirror without getting into an accident. So I always like to look forward. And the PMI is basically a wonderful forward-looking indicator. And what we found based on our research is that when the last month is above the average for 3 months, you start seeing oil prices and copper prices rising, then steel prices, because it's a reflection of future global economic activity. If you get an order to build 50,000 new copper motors, well, you're going to use a lot of energy and employ a lot of people to make those motors. You're going to consume copper. So all of a sudden you start seeing the commodity prices rising.
Frank, you put out the periodic table of commodity returns each year, and I'm seeing the one that highlights 2016 against past years. Very exciting there. The only two commodities that were down on the chart are wheat and corn, so agricultural commodities. But you had things like coal at the top up over 100%, zinc, natural gas up 60%, and a lot of the other commodities were in the double digits. What do you think might be the surprise commodities of 2017?
Well, there'll always be rotation in that marketplace. But I think you could probably see gas have another great year, natural gas. And I think that copper and uranium could have a big surprise on the upside, because uranium always is a lag when price of oil starts to rise and natural gas starts to rise. Then all of a sudden you get a surge in uranium. And with the leadership of President Trump, it's even more so opportunistically looking that uranium prices will trade higher. It is clean energy, and the use of electric cars is going to need, not only lithium is going to remain strong, but you're going to need cheap electricity.
In your article, you talked about Trump's election in November ushering in a lot of the moves of these commodities. And I want to ask you if you think this is a sustainable move, because many of the commodities are moving possibly as a knee-jerk reaction to Trump policies. The Keystone Pipeline construction you talk about, moving auto manufacturers back home. So how much of this is sustainable?
Oh, very much so. When you have the largest GDP in the world having a complete different fiscal policy change, I think is very significant. The biggest risk is managing global trade and how that's done. That's the biggest risk. But I think that the U.S. is on a tear here. And I think the biggest thing is to recognize what Trump has been doing is deregulation. And he said he can drop regulations by 75%. That basically unleashes innovation, competitive, creative spirit of America. And I think that will be the tipping point. If these regulations don't decline, then it'll be a slow growth. But what's to me is fascinating for your listeners is that the world really started to change with Modi in India. This is a maverick. This is like a Trump that was very successful in the most prosperous state of all of the India, the Gujarat district. And he has created incredible change. In this past year, he wiped out 87% of the paper money to reinstitute new paper money and to basically wipe out corruption. You have the same thing happening in Argentina with ushering a new leader, which is very much pro-America, pro-trade, and pro-global. And you're seeing that the land value in Argentina is improving. You're seeing more mining companies. They're doing everything to attract economic development in Argentina, which is completely different, say, than Venezuela. So I think that Trump, and then the other one would be what happened in Brexit. And I find them, to me, most fascinating. Those viewers, those talking heads on mainland television around the world that are anti-gold or also anti-Trump and anti-Brexit, but they're in motion and they're going to continue.
I've heard you talk much in the past about proper weighting of a portfolio. I think a lot of gold bugs are extremely overweighted into one sector, but you've always advocated having some precious metals physically, having some gold stocks or commodity stocks at the right time, and then balancing that out in some other areas. For 2017, what would you suggest to our listeners on how to maybe properly balance things?
I've always advocated a 5% in bullion and coins or beautiful estate gold jewelry, and another 5% in quality gold stocks. And I think the royalty stocks you're looking for big blue chip stocks, I'd always prefer to own the royalty companies like Royal Gold, Franco-Nevada, Silver Wheaton, Sandstorm. They just have higher profit margins, higher revenue per employee. They went down a lot less, in particular the Franco-Nevadas, during the down cycle, and they've also moved up. So that to me is important. And then you have the mid-cap stocks, and I think you're going to see many of the seniors go after the mid-cap gold stocks just like the mid caps are going after the juniors. So this will be an exciting year of M&A work in the gold space.
Frank, I do appreciate you coming back on the show.
Well, thank you for your kind recommendation, and wish everyone a happy investing in 2017.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?